Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss private credit fallout. I'll also take a look at credit card rewards and bundled banking services, and then we'll venture on over to the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we today, good sir?
Well, we made it. We made it to April 15th. So this is normally my favorite time of the year because it's the most amount of time I'm going to have before we start in again on the next tax season. So, looking forward to things slowing down a little bit.
Yes, sir. Yes, sir. As the weather, well, I don't know. We're kind of here in Central California and Northern California, so weather's been a little bit wonky, but at least enough to be able to get outside here and there.
Yeah. Kind of been back and forth, but at least it's nice today.
Yes, sir. All right, let's dive into private credit fallout. This is really interesting. This was one of those real eye-opening pieces here to the Personal Financial Review. But it seems the private credit market has been rattled, has rattled Wall Street, and the broader credit markets recently. Why is that?
Yeah, I mean, this is a familiar pattern we see on Wall Street that just seems to repeat over and over, sometimes with really big implications, sometimes with more muted. It's not that private credit in and of itself is bad. It's a perfectly, acceptable investment tool, when used properly in the right situations. But what we see on Wall Street is they have a tendency to reach down in that toolkit and find this maybe very specialized tool, that only fits certain specific situations, and say, hey, let's expand this. Let's raise money and do more of this and make it bigger. And then you get a lot of hype around it and it kind of takes on a life of its own. You could go back to the mortgage crisis, right? That was around subprime mortgage loans. Right. These were private loans, not government backed, that normally were designed for very select situations where maybe someone's credit wasn't great or maybe their income wasn't enough to, cover the loan, but they had a lot of assets maybe. Right. And so you look at it and say, well, OK, they have a lot of collateral, so they're still a good risk. Right. You look through things like that and say, OK, in this special situation, it does make sense to lend to this person, even though they don't fit into the cookie cutter formula. And historically, subprime loans were 3% of the market, maybe if even that much. And then, by the peak, they were around 50% of the market, clearly not fitting what they were designed for. And we all paid the price for that. Yeah. In 2022, the downturn that we saw was around the SPAC. SPAC stands for Special Purpose Acquisition Company. It was a very specialized way for a private company to go public at lower cost and less regulatory disclosure, right? But it really only made sense for the rare private company that was positive cash flow and really had good financials and wasn't in that growth mode where they needed to raise a lot of money as a part of going public. But for whatever reason, a bunch of firms raised money. These SPACs got really big. They took all these companies public. And in a lot of cases, it did not work out. There was a big adjustment because the companies they took public really didn't fit that ideal company, right? For the tool that they were using. They probably should have gone through a normal traditional IPO, initial public offering. So here we are, I think at Plan Solutions, we talked a lot about this and saw this coming, and now it's finally making headlines that, there's probably going to be trouble in this private credit market because the private credit market is, again, it makes sense, but, it's not a huge market. And it typically is a place where a lot of institutions invest, not individuals. And there was a lot of money being raised among individual investors as a way to build out these private credit funds. And they were really focused on the fact that you could get a little bit higher interest rate
Right.
on these bonds, right? Of course, we've been doing this long enough that we're trying to say, well, wait a minute, if we're getting a little bit higher rate of return, what risk is that return compensating us for? Right? We want to know what risk are we taking on because really there is no free lunch, right?
Right.
If you're getting a higher rate of return, at least if it's consistent, you may find an occasional mispricing or something like that. But if it's supposed to be a consistently higher rate of return, what's the risk? And in the case of private credit, the risk was liquidity.
Yeah. Yeah. It's so, but break it down for me that is this what we're seeing affecting the lender, the borrower, or both?
Well, it's kind of a systemic thing. I mean, the losses, anytime a credit relationship goes bad, right? Everyone
Yeah.
loses pretty much. So,
Right.
so I guess you can say a little bit of both. But in essence, what happens is, you have, these different investment groups raised a lot of funds. And so they're going out and they need to lend, right?
Right.
They need to extend this private credit. And if they raise more money, they need to fund more loans. And you can kind of think of it as at any given moment, there's X number of borrowers that are coming to the private credit market. And if you're a lender and you rank them and you say, okay, well, first, obviously the one at the top that looks the best, I'm going to lend to them. And, then maybe the next one and the next one. Okay, well, I'm out of money. But if you increase the amount of money being raised, you're going to go further and further down that list.
Yeah. Yeah.
So you're going to be making loans that are more marginal, right? That have higher risk, and maybe that's partly adjusted for in the interest rate that they're paying. So you'll charge them a higher interest rate, but it is going to increase the likelihood that you're going to have a major default, and that's what happened. There was a company that was involved in rolling up different auto parts manufacturers that was doing a lot of those transactions with private credit that then it came to find out they were not being completely honest with the accounting and the paperwork that they were using to get those loans, and so that company declared bankruptcy, which of course bad for the company, bad for people that worked at those auto part manufacturers that were being bought up because now it creates a lot of uncertainty there. But also bad for the investment managers that were promoting these private credit funds. And of course, in the end, mostly bad for the investors that provided the funds, because chances are, they won't get all of their money back. They'll probably get a very small percentage of their money back, and it'll probably be delayed quite a bit.
All right.
Um,
Yeah, thank you. That's kind of what I was looking for because before you jumped into liquidity, I just needed that clarification for myself, and I want to expand now on the liquidity aspect because as far as private credit, I've mostly known it related to the housing market. So I know you use that as an example. So could you expand now on the liquidity aspect as far as the constraints and how it works as far as private credit?
yeah, so the liquidity comes in where, if the market's only so big, right? How well can it function in terms of money coming in, money going out, right? I mean, liquidity is your ability to withdraw your money at a reasonable price compared to the last price, without any big delays or expenses related to that, right? So basically, being able to access your money very quickly. If you think of a checking account as an example, right? Very liquid. You can withdraw the money at any time and you're going to get that amount of money and you're not going to pay big transaction fees or deal with long delays. On the flip side, an illiquid market would be like real estate, right? If you suddenly wanted to sell your house, you're not going to be able to sell it real quickly, without having to discount the price significantly. And there's going to be high transaction costs, right? So, with like the real estate market, if there's too many people in one area that all of a sudden want to sell, you'll likely see the price dip. Whereas with the checking account, if a whole bunch of people, are writing checks on their bank account, they're not going to see a reduction in value, right? So that's kind of an example of the difference in liquidity. And so the private credit market has never really been that liquid because it wasn't designed for trading. I mean, mostly these private credit, holdings would go into like pension fund portfolios or insurance companies, right? That are really long-term investors that actually don't care about the liquidity because they don't plan to sell. They plan on holding the loan all the way until the end. And as a result, collecting a little bit higher interest rate because they gave up the ability to access their funds, quickly at a reasonable price, right? And so it made sense. It was the right type of investor with the right goal being matched up with the right type of investment. Unfortunately, retail investors just don't behave that way.
Right.
Right. And, we're talking about if private credit's making all of these loans and they're going down the list to more and more marginal borrowers, it doesn't mean that all of the loans are bad. But when you get a big, headline of a default, right, it creates a contagion. Everybody starts to become fearful. Oh, what if my investment's next, right? So they want to sell. And if there's not a lot of liquidity and you have too many sellers all at once, it causes the prices to drop, and they can drop pretty significantly to the point where, you're either seeing big losses, even on loans that may pay off in the end, right? But it's just that there's no buyers coming into the market and there's only sellers. And so that's going to keep pushing the price down. And so because of that, kind of that short-term thinking and that contagion effect, people that are able to get out are potentially getting out at big losses, or in some cases, because these markets are so illiquid, the investment companies that promoted it are just suspending liquidations, like basically just saying you cannot sell, right? We can't sell these things, so we can't give you your money. You just have to wait and see how things work out.
Yeah, yeah, no, it's an interesting time, and I know that you mentioned something that there was some sort of level of histrionics before. Have we seen this as far as the private credit market, or just similar circumstances, similar lending, borrowing practices as you outlaid the housing market back in the early 2000s and so on?
Yeah, I think it was Mark Twain says history doesn't repeat, but it often rhymes, right?
Uh,
We've never seen this exact same thing, but we've seen very similar things in credit markets where smaller niche products just become too popular too quickly. And it seems like there's a lot of liquidity because there always is when the money's flowing in, right? The real test of liquidity is how does it hold up when the money's trying to flow out? And the way these were marketed and I think the expectations, it just was not a robust enough market to meet those needs, which is why it's a lot of these types of investments are just worth avoiding. I mean, I know it sounds great, like, oh, look, you can get this higher interest rate, and everybody's saying, oh yeah, and historically these have done well. It's an investment strategy that I often refer to as picking up nickels in front of the steamroller, right? You're getting a little bit higher rate of return, and you just see this long line of nickels out to the horizon. You say, all I have to do is just keep moving forward and picking up the nickels. This is great. But the steamroller's there, and the steamroller only has to get you once,
right.
right? The nickels will keep coming, and it may go for quite a while and seem like, oh, this is so good. But eventually, that steamroller gets you, you're in big trouble. And the biggest challenge is people will go into these investments. All they're shown and all they see is the long line of nickels, and that they're going to get this little bit better rate of return, and that's going to be great. And the steamroller is, that's in the fine print, right? That fine print that nobody reads that says, oh, you need to be aware of these risks. And in this case, the more marginal, borrowers, because the market had expanded so quickly and the lack of liquidity was that steamroller that was probably disclosed, but was not, not really promoted, right? It was people were focused on the benefits and not the offsetting costs of such an investment strategy.
Yeah. What does this mean for maybe those in need of short-term funding moving forward?
Yeah, it could create a little bit of a credit crunch, right, for businesses that historically have relied on private credit. Although we have seen a lot of that borrowing shift into other markets that probably, traditionally is really where that borrowing should have occurred in the first place, right? So,
Mhm.
things like the high yield bond market or the floating rate bond market, those are more liquid markets, come with higher standards and sometimes higher costs, also offer competitive interest rates, but yeah, into markets where they're more public markets and there's greater liquidity.
Yeah. All right. Let's dive into credit card rewards. We have touched on this in the past, but I'm glad that it came up again. I think it's been a couple of years since we've talked around it. Credit card rewards. I know I have some. I believe that the previous episode we discussed this. You shared around it, essentially with the idea behind a credit card or travel rewards. Something that when the customer spends on the card, right, they're going to get benefits, the airline travel, hotel, and so on. And also that the creditor can build loyalty essentially to the brand, so to speak, and continued spending. But what do we really want to unpack with people around some of those perceived perks or oftentimes, right, the word free that comes with a lot of it. And it's kind of like, okay, you might want to question that language a little bit.
Yeah, yeah, yeah. I mean, a lot of these, it's a marketing type, strategy, but really when it comes back to it, it's a rebate, right? The credit card company charges a point of sale fee to the merchant whenever you buy something, and then they're rebating you back a portion of that fee, right? So it's kind of like you're overspending, at the gas pump or at the grocery store, but then this is a way you can get some of that back, and you have lots of options on how you may get it back, right? So. As we've talked about in the past, it's important to figure out, okay, what rewards are going to have the most value for you in terms of offsetting your highest expenses. I've shared I set up a credit card that deposited 2% of all of my spending into a 529 educational savings account. I did this before we had kids.
Mm.
And now there's significant amount of money in that account, as you can imagine, over 19 years of contributions going in and investment returns compounding. So it's been extremely valuable in terms of offsetting what was gonna potentially be a major expense for me. Now, for other people, it might be a way to offset, travel or maybe just the cash back, right? That those cards offer. But what we're seeing is a lot of the cards are now reducing their benefits or putting, greater restrictions on them. So I think it's a good time, for people to review it and say, okay, does this make sense, right? Are my points expiring? Are there, blackout dates? Are there things that just make this to where it's not as attractive as it was in the past? And does it make sense to, either shift your habits, right? Something I referred to as a, earn and burn strategy, right? Don't accumulate the points where they may expire, but, have plans to use them more proactively. Or, shifting to a card where the terms are more favorable, right? So that the individual gets more value out of it.
Yeah. Well, and I like the way that this was closed, that it stated a credit card reward strategy should also be balanced with the negative impact that switching cards too often can have on a card holder's credit. Um, which is great foresight to have, because you obviously don't want to have too many open accounts and juggling around, or maybe not utilizing certain credit cards at all, or having ones that maybe don't have any perks to them or benefit at all, especially if you do have a good credit rating.
Right. And length of credit is part of it, right? So if you open up a new one, obviously it's going to average down your the average length that you've had those. And yeah, you have to realize your credit score really is based on how profitable you are to the lenders.
Hmm.
And if you're constantly opening new cards to get that sign up bonus, right? They know that's costing them something. they'll give you that sign up bonus or that, 15,000 points, right, to open the card, which may be a good deal, but you don't want to then be switching to another one and then switching to another one, because then your length of credit is going to be very short, which is what what the credit card company is hoping is that you sign up, they give you all these points to sign up, and then you stay with them for a long time, right? So they recoup those costs with, a profitable engagement over time. If you switch very quickly, you're not going to be as profitable. And so the way the credit score is set up, it will cause your credit score to go down. So if that's a consideration, there's any major purchases or anything like that, you want to weigh that versus the marginal benefit you may get from a rewards program that's a little better than what you have now.
Right. And to tie in, and then we touched on this in a past episode too, and tell me if my thinking's on track. The reason they'd want you to open new cards is creditors. Most people think that the money is made on interest accrued or somebody has a balance that rolls over, but no, it's those transaction fees that they receive from locations when you utilize that credit card. Am I correct in remembering this?
Absolutely. Point of sale fees is where they make most of the money. The credit card companies, they really don't want you to carry a balance, and they don't want to be charging interest or to send you to collections, right? I mean, all of that actually ends up costing them money. If they can get those point of sale fees as compensation for loaning you the money for a very short time period between when you make the purchase and pay it off, that's an extremely profitable business model.
Yeah. All right. Let's jump to bundled banking services. I've seen this a lot myself recently when I've gone into the institutions I bank with, where the banks are offering a combination of two or more financial products: checking, accounting, checking, savings, very common. But also loans, credit cards, and investment accounts. I'm seeing a lot more of that come through, especially to my email and even text messages. So, what is the goal here? Why are banks really starting to get more into that investment space? And what do we really want people to understand around this?
Yeah, well, I mean, obviously the goal of the bank is to increase their revenue per customer, right? Because that's going to increase profitability. They want to leverage those existing relationships. And if you listen to, JP Morgan Chase or Bank of America's earnings call, that's what they talk about, right? We have this big customer base and we're going to try and sell them this, or that, and that's how we're going to increase profitability, right? So they're actively mining their existing customers for more revenue and to increase the profitability. And so one of the ways they may do that is offer some perks, right? Say if you use two or more or three or more services with us, whether that's checking, savings, money market, could be an investment account, could be a mortgage. We'll offer you free checking or lower ATM fees or a little bit higher interest rate on the investment account. I mean, those things are always worth exploring and getting the details. But what a lot of people don't realize, if you take a big picture approach, it's not that often that, one company has the best offer for all of these different services, right? I mean, they may do one thing really well, maybe two. It's pretty rare that you have a company that's, the top option for all of those versus another company that maybe really focuses in on certain things. And so what we tend to find is, someone may say, oh yeah, my bank gave me this, money market account with a slightly higher interest rate, right? And they're like, oh, this is a great deal. And we take a look at it and we say, that's half of what you could be getting over here, right? It's higher than what they offer everybody just, that they advertise, and they'll give you a little bit more, but it's well below the market standard. So actually, the amount that it's costing you and lost potential earnings is pretty significant. In other cases, it can create potentially some conflicts of interest where they're going to use proprietary products or specific things just to them. And like with an investment standpoint, if you go in and set up an investment and all of it's going into just one company, you have to ask, is this one company the end all be all investment company, and they've somehow mastered every different type of market? Right. Or would I be better off, splitting the money up into different companies based on the different, asset classes that you want to be invested in? And quite often, if it's all in one company, It's not there because they're the best at all of those investments. It's there because there's a marketing relationship.
Right.
And the bank in this case is making additional money off of higher fees that you are paying in order to feed you into that investment, right? So it may not be the best in terms of the overall investment opportunities that are available to you and the additional costs.
Yeah, and I've found, and I know you included it here in the personal financial review, that I did do a little out of curiosity, that exploration. And one of mine questions when I asked, well, what about the advice and guidance tailored exactly to the needs that and goals that we have? And it seemed very limited. I don't know if it's the individual was more just, hey, I'm the front end salesperson. I let the other individual kind of, you know, pad the deal as it's closed. But that was definitely a thing that stood out to me. That it was no, that's why I invest the way that I do and work with who I do, because I want that individualized care of someone that knows what my goals, needs, and so on are.
Yeah, yeah. In a lot of cases, right, this is focused on building out the revenue, offering these additional services, but not necessarily being really serious about, the level of those services, right? And in some cases, even, these are markets that they say, oh yeah, we're going to try and build it up, but they're not really dedicated to it because it's not part of their core business. And I've seen plenty of cases where they then abandon it after a short time period. Say, well, this isn't working as we thought. They abandon or they sell it off to another company. Um, so yeah, it's I think a lot of times the client or the customer can really kind of feel like a commodity, right? Just getting shipped around like a number that they're moving around on a balance sheet. Rather than that you're really getting that real focus on your individual situation and what your goals are.
Yes, sir. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We got two items pinned up there. What are they, Chase?
Well, first one is, as we talked about at the opening, right? Tax season's come to an end, so it's nice, a little period to decompress. But I just want to remind people that doesn't mean it's time to stop thinking about taxes, right? I mean, what I saw this year was a lot of taxpayers learned that their result at tax season was largely driven by the time and effort they put into planning during the year, right? I mean, with constant changes in income deductions, credits, tax law changes that we saw this last year, it takes constant planning and monitoring to make sure everything's homed in to work out. And if you do that, my experience is you're going to be really close, right? You're going to be really close to break even. Maybe you owe a little bit, get a little bit of a refund, or whatever your target is. You'll probably be pretty close to it. Those that didn't put in that effort, are often the ones that are shocked, right? That, oh my gosh, how did I owe this much? Well, could have seen this coming, but you have to be proactive about it. And so you're prepared and possibly even hopefully even have some ability to make some changes, right? To avoid it or at least reduce it.
Second item we have pinned up there.
Yeah, so this was interesting. So, Carter, one of the new guys, really been working hard, and he's been getting out there and trying to be more active in the community. And he was part of a volunteer organization, and they asked him to speak at their 2026 Continuous Quality Improvement Conference. So really, the theme is breaking barriers and building brave young leaders, right? Really helping people reach their potential, and so it's trying to bring together professionals from across California, and they kind of brought Carter in as one of the, I guess, inspirational examples, right? As a young man who finished college, has moved in early in his career, doing well, but at the same time young enough, right, that the younger people will be able to relate to them versus you bring somebody like me in, right? They probably would say, what's this guy talking about? So yeah, I think it's great, that we're seeing them get involved in the community and really, helping Plan Solutions kind of spread out and do good in different ways than we've been able to in the past.
Yes, sir. Absolutely. Yeah, Carter's a wonderful young gentleman. It was a pleasure to get to know him more so at the golf tournament this last year. So, thank you for sharing that, and thank you for listening to the Plan Solutions Incorporated podcast. Again, Apple Podcasts, Spotify. Hit that subscribe button, and please leave us a rating and review, and share the podcast with somebody else that you think will get value out of it, because we don't do any external advertising, so it continues to help the podcast grow. Chase, anything else in closing that you want to lend?
No, just want to thank everyone, for being patient, especially the last few weeks through tax system. Is, occasionally we get a little inundated, and we like to be very quick on our turnaround on client service requests and things, but occasionally it may slow down a little bit, when we're just really slammed. But just thank you to everyone for being patient, and I think we'll be back up to our normal standards as things kind of normalize here.
Yes, sir. And if you need more information on Plan Solutions, details are in the podcast description. And if you want to subscribe to the Personal Financial Review, the written content that we discuss here on the podcast, it's easy to do so. Just send Katie an email and get subscribed today. It's katie@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.